Joining us now, Truist co-CIO Keith Lerner. Keith, you're still in the slowdown camp for later this year.
Yeah, well, great to be with you. I mean, the economy has been extremely resilient, but there's this, this tension between this fiscal dominance and monetary policy that's still, tight and likely going to move tighter. So we still think things, slow down. But, near term, as we all know, if you look at something like the Atlanta GDP, we're looking at a really strong quarter. But we do think those rates will weigh on the economy later this year. We'll also continue to see some tightening in the lending standards as well.
So you see some lags out there. What are some of the other things that you're focused on?
Well, more broadly for the market, we came into August thinking the market on a short-term basis was somewhat stretched and vulnerable to some type of correction in time, meaning moving sideways, or price, meaning pulling back. And we're seeing a little bit of both. I think what the challenge for the market right now is there's just a lack of catalyst. We just got through the earnings season, and the earnings season was really good. The average margin of the beat was about 7%. But here's what the most interesting thing is stocks that had positive earnings actually declined. And that's an unusual circumstance that we haven't seen often over the last 10 years. So we think we're just, basically we had a lot of good news, a lack of catalyst, and we're just digesting these big gains from the first half. Just one last point is the good news is we are seeing that reset. We're seeing the amount of stocks oversold and sentiment kind of come back in a bit as well near term.
Keith, what are your S&P earnings numbers for next year? Are you tweaking that?
Yeah, we instead of trying to focus and predicting a simple number, we watch the earnings revision trends a lot, Carl. And I think what's underappreciated right now, more on the positive side, is that forward earning estimates are at an 11-month high. So a lot of negativity on earnings, but those earning estimates will continue to drive higher. And what's good about this pullback we've seen is we've seen the PE of the overall market, contract while earnings are still going up. So listen, stocks are far from cheap on a historical basis, but I think that's somewhat healthy that we're actually seeing that reset. Yeah,
that's sort of, that's definitely the bull food right now is that positioning has had a bit of a correction in itself, buyback windows opening up, and as you said, that valuation not looking quite as rich. I guess I just wonder how far that carries you and whether or not you think conditions are ripe for any kind of chase mentality in Q4.
Well, the seasonal trends would suggest, the potential for a better fourth quarter. But seasonals are just one thing. I will say, kind of what we're looking for here near term, Carl, is, so far we're down about 5%. We have really strong support for this market around that 4,200 level. If we remember, that was the old breakout point. That's about 3 to 4% below where we are today. One thing that's somewhat encouraging, we have an indicator we look at. It says what percent of stocks in the S&P are oversold or getting stretched. That's about 65%. That's the most since March. And historically, you don't go much beyond that unless you're back in a bear market. So I think whether we start to see some traction over the next few percent will be an important tell. But again, these corrections tend to last 1 to 2 months. The average correction tends to be about 7 or 8%. So we're still in the ballpark of normal right now. And at this point, we still think the primary trend is still higher, but again, in a choppy fashion, and that's still our call today.